It was Benjamin Franklin who said, "There's nothing sure in life save death and taxes." And in Ireland, death means taxes. It means inheritance tax. And inheritance tax is probably the least fair tax that is levied on Irish citizens. I say this because if you think about it, the donors, the people leaving the assets, have already paid huge amounts of tax as they've accumulated these assets. And then when they simply hand them off to the next generation, that generation pays huge amount of tax as well. Luckily, there are a number of legitimate ways to reduce tax liabilities. And let me give you a few examples. Firstly, there are assets from time to time that are exempted by the revenue authorities from inheritance tax. One example is art on public display. So there's a famous legal firm in Dublin with offices close to the Conrad Hotel there. And if you walk into their foyer, you'll see a number of Graham Nuttall paintings around on the walls. What you're looking at is the inheritance tax planning of the partners, because they're art on public display, and once properly registered as such, they would be exempt from inheritance tax when they pass from this generation to the next. What else might you do? Well, I've mentioned before certain reliefs, like agricultural relief or business assets relief, but I've also cautioned you to fully understand what the qualifying criteria of the beneficiary is for those reliefs. Because if you simply do what most parents do in Ireland, which is have a will that says, I leave everything to my spouse, they leave everything to me if one of us is dead, and we leave it equally to the children, that equally to the children could mean that certain reliefs no longer apply. So it's vitally important you check out the qualifying criteria. What else could be done? Maybe there's a trust fund in the future in your will. And trust funds can be used to delay taxes. And they can even be used, as long as they're given time, to instruct trustees post the death of the donor to invest in exempt assets and delay giving the assets to the beneficiaries until those exempt assets are exempt from inheritance tax. Finally, there's a simple solution out there, and that's the life insurance solution. Under a policy called a Section 72 policy, it is possible for the donors to insure the tax liability, to have a life insurance policy that pays the tax liability as soon as the second death occurs, because that's when the liability generally occurs. And the payment out from the life insurance policy is itself exempt from the inheritance tax. As long as it's used to pay inheritance tax on the balance of the estate, itself is exempt. Now, I've run many quotes on that type of cover for my clients. I ran one the other day for clients in their late 40s, early 50s. And those clients would have to live to 160 years of age for that policy not to pay huge dividends. So there are many different legitimate ways to avoid inheritance taxes or to lower them considerably. But you're likely to need the services of a full-time, regulated, experienced financial planner to be able to use them all.